So here we go. This is what I think Twitter is worth. This is based on two different valuation methodologies. First, we have a price to sales valuation methodology, and then we have an EV to EBITDA valuation methodology. So what do I think Twitter is worth? Keep watching, find out. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. What's up everyone? My name's Robbie. This is Robbie and Manila, and today we're doing a stock analysis of Twitter. Hot off the press, Elon Musk put a bid in to buy Twitter for $54.20, and he wants to take Twitter private. The actual offer was rejected by the board of directors, and now Twitter has put in place something called a poison pill provision. So basically, a lot has been going on with Twitter lately. You're going to see in the chart, Twitter's kind of a crazy chart, and already it's even kind of crazier now. And we're going to go over a valuation of Twitter and see what I think it's worth. Going straight into this, we got the price to sales valuation. What do I think this company's worth based on this methodology? So it's $45 for my price target for 2022. It's essentially a fair valued stock using this analysis. By 2026, the target price would be $76 per share with this one. That would be an 11.14% rate of return, so that would be good. And so, if I was thinking about this, if I was on the board of directors of Twitter, and this is what I thought, my time horizon, it is what it is, right? So if I'm looking at 2026, and I think the stock is worth $76 per share, and, this is the rate of return I want by then, I might not think $54.20 is a good price to sell Twitter for, right? So I would vote no, and essentially. There's a lot of different factors, Do they think that there is value to be unlocked for Twitter? Are there things that they have planned that they really do think is going to increase revenue and profits, right? So we don't know the exact reason. I'm not sure what's going on, but I would say just on this valuation methodology right now, I would not say yes to that offer if I was on the board, which I'm obviously definitely not. Let's talk real quick about how I got to this. So we have shares outstanding. That's step one. We have to forecast that. I have them diluting shares at 2% every year. They definitely dilute shares. The share increase over the past 10 years has been 15%. So, it's really bad in terms of dilution. But over, 5 years, the rate of return of dilution has gone down more and more. And, 3 years, it's under 2%. So anyway, I went with 2% here. Step two is to forecast sales growth. We have different numbers of some rates of growth over different years. So we have a median here of 27.36 for their growth rate in revenue, and then average is 26.57. So these are close. We can see that over a longer term period, 36% revenue growth, that's very good growth. Over 5 years, it's lower, it's 14%, but over 3 years and 1 year, it's actually a bit higher too. So we have to decide what we want to use here. I'm actually using a 20% revenue growth to start this thing off, lower than the median, lower than the 1 year, but closer to the 3 year. So, I think it's okay. I don't think it's a very aggressive number. And I have it declining, 18, 17, 16, 15%. 5 year average was 15%. So I think it's okay. I'm more comfortable with going like this. I think it's slightly conservative. So now the next thing we just have to do is we have to think of what the multiple is for Twitter. So we have a price to sales ratio. What do we think it's going to be? These are the different price to sales ratios over the past. This is essentially at the end of the year of these years. So 2021, it was 6.79. It's currently at 6.9 as a price to sales ratio, and you'll see it's currently trading below its average and median price to sales ratios. They've been higher in the past. So what I'm going to do here is I'm actually going to use a price to sales ratio less than the current price to sales ratio, less than the median, actually less than any of these price to sales ratios have been. I'm going to use a 6 as a price to sales ratio. This is going to give me a target price of about $45 per share. Essentially, it's fair valued right now. The stock is trading at $45.08, so it's fair valued. And then, we have it growing up here, $76 per share, an 11% rate of return over that time period up until 2026. Pick your flavor. Do you want a price to sales ratio of a 2? Do you think it's more of that type of company? this would be the prices, these would be the rates of return. You think it's more of a 10, right? So depends on what you think. Is there value to be unlocked by Twitter? Are they going to do well gaining more active users? Are they going to do a better job actually monetizing those users? I use Twitter a lot, actually. I'm a very active Twitter watcher, I would say. I'm not a big tweeter. Let's move on to the EV to EBITDA valuation. So what I have here is a lower price, a $27 price target. Now, this is 41% overvalued if I use this methodology, and then growing to $42, which is still like down, a percent over that time. So in this one, I would say that in this situation, that offer from Elon Musk, I still wouldn't necessarily want to buy it because my time horizon is probably going to be more than 2026. But if I do think that there's major problems with Twitter, then I'd say maybe it's a good thing to do. But honestly, I probably wouldn't accept that offer if it was me and I was on the board. Again, why would I even be someone on the board? I'm some random dude on YouTube right now, right? So let's talk about the first step, which is forecasting shares outstanding. We had the same thing as before, 2% dilution. Next up, we have step 2, we have EBITDA forecast. So what do we have here? EBITDA is all over the place. It's very lumpy. So over 1 year, 57%. Over 3 years, down 2%. 5 years, up 87%. No 9-year number. I mean, it's kind of crazy, right? So this is actually a bit harder to forecast, essentially. What I did was I said, okay, let's give them 30% EBITDA growth because we've had some big growth numbers here. And let's decline them pretty rapidly down to 10%. And I think I'm comfortable with that, so that's what I'm going with. For step 3, we have to pick an EV to EBITDA multiple. This is a harder one to figure out. So we have 2017, we had 37 multiple, 2018, 18 multiple, up to 182 multiple in 2020. It's all over the place also. The average is 65, but the median's 37, and these are high EV to EBITDA multiples, honestly. If you look at a Google, if you look at a Facebook, those are under 20. So I went with, definitely under these numbers that we're seeing here because I'm not comfortable going with something that's higher than what I maybe think the average is in the industry. So I'm going with a 22 for an EV to EBITDA multiple. That is going to give us a 27 essentially dollar price target this year, which is negative 40%. Basically, it's overvalued by 40%. And then this grows to $41, which would make it essentially a break-even investment. Like you would sell it and you wouldn't make any money. In this regard, it's probably not the best company. And so what do I think? I think it's somewhere probably in between those two right now if I'm talking about a 2022 price target. So we're going to go over the price target in a sec. Let's quickly go through my Cat 5 score, which is something I've created to help me go over some additional things I like to see in a company. Now, this is called a Cat 5 score because I have 5 different categories. I rank them, and they are almost all of them are based on industry averages, and I use deciles. I'm going to show you how this works real quick. So here's an example of sales growth. So I took 39 different companies inside the industry that I think Twitter operates inside, and I said, okay, what are the deciles of different growth rates? And so what that means, I'm sure you might not know what that means. So if you're in decile 1, you're in the highest, essentially, growth rate decile. So 67 was like this decile for growth. Now, if you're in the next 10% best growth, you're in the third. You have 38% essentially, 38 to 28%, let's say. So essentially what I'm doing is I'm just ranking them into groups of 10. The decile 1 means it's the best. So going back, we have the industry-based valuation. I use PE ratio, forward PE, price to sales, price to free cash flow. If you're a decile 8 or more, you don't get any points. If you're decile 5 to 7, you get 2 points. For decile 1 to 4, you get 5 points. So there's no PE ratio to work on here. The decile 7 for forward PE, that's not great. It still gets 2 points, but not great. Price to sales ratio is also high. It's in the 9th decile, so we don't like that. That's a 6.9 is the price to sales. Remember, I'm forecasting and using a 6 as a price to sales, so lower than this. We also have price of free cash flow for this one here. So this basically, I have 20 points. This only gets a 2 out of 20. Not a good score. This is a 10 on the peer valuation score. So this essentially tells me that valuation-wise, not loving how the stock is looking. Next up is the industry-based profitability, the gross margin. Decile 6 for the gross margin. Okay, not too bad. 64.60 is the gross margin, and then the net margin is 5, which is actually negative, which is funny because in this industry, that's actually not too bad. It's in the 5th decile. So it still gets 2 points for each of these. Out of 10, this gives us a 40 for a pure profitability score, has its score essentially against its peers in profitability. Next up, we have the pure growth score. So does this company do well in growth? So in revenue growth, it does do well, 15% annualized over 5 years. So that's good in the 3rd decile. Earnings per share in the 5th decile, 15.70% over 5 years. So out of 15, we have a 47% peer growth score. And then liquidity, I just want to see a lower than 2 debt to equity ratio. This has a 0.58, so does very well in debt. That's a 5, that's 100%, so that's fine. Then F score, if you haven't watched my F score video, take a look at that so you understand what I'm talking about here. But I like the F score to be a 7.89 usually. It's a 6, not too bad an F score, it's fine. Gets 2 points. Shares are increasing, so they're diluting us. Not my favorite thing. So I'm giving them 0 for this one. So this gets a 20 out of 10, 2 out of 10, 20%. Not the best Rolex score. So what do we have here for the total Cat 5 score? Out of all of these things, we have a total score of 20, total possible score of 60, a Cat 5 score of 33%. I like it to be 70 or above, so this is not a very good Cat 5 score for the company. All right, so Cat 5 score, not that great. What is the average target price, though, of this company based on the 2 valuation methodologies I did before? So let's go here and take a look. So we have the 2. We have the price to sales valuation. We had $45 per share here. EV to EBITDA valuation, we had $27 per share. We're going to weight these 50-50 here. It's going to give us a $36 price target. Essentially, this company is overvalued by 20%. But we're going to look at the chart here, and you're going to see that essentially this was fair valued like 2 weeks ago, and then Elon made that offer, right? So let's talk about this whole thing. This is a chart of Twitter. We're going back pretty far here. We're going all the way back to January of 2014, and basically what this is showing you is that back then, Twitter was as high as around $70 per share, and then this company went absolutely nowhere for a long time. It traded all the way down into like the $13 area, hit some peaks over here in June of 2018 at 47. You know, it's still trading right around there right now. So a lot of people have made no money on Twitter. A lot of people have lost a lot of money on Twitter probably. Some people have made a bit of money on Twitter. But honestly, in terms of the chart, if we kind of like go in here and we're going to zoom in a bit and show you more. If I was really trying to do like some type of trading thing here, I would be interested in Twitter because there's definitely high volume because, of course, Elon Musk put an offer in. And you'll see that this thing, when we kind of zoom in here, hit exactly about what the offer of Twitter was, Elon's offer for Twitter. So when something like that happens, people buy up to that point, and then they probably don't pay anymore because they think maybe the offer is going to go through. Offer was declined. Elon says he has something up his sleeve, but you know, you can't always listen to what that guy says because honestly, he talks a lot and doesn't always follow through. So we'll see what happens. Not sure, but if this thing fails, if nothing happens with this Elon Musk purchase of Twitter thing, which I don't think it's going to happen, this thing probably will come back down into this downtrend channel. You know, we're talking about the channel's probably going to be in the 34 area. It was just kind of peeking out of this up downtrend channel at the time when this was announced. I think it might go back down into that. I do see definitely some resistance here. Support here at the $45 area. And this actually has some history behind it if we move back out. So we had resistance here. So resistance at this level. We had support at this level here. We had some resistance at this level here. And so now it's acting as support. So this is a historical price that might give us some support. And so if it does go down below 45, say nothing happens with the Twitter buyout, I think it could go back down to this channel. And in this point, then we're closer to the $36 price target I have on the stock. You also have some moving average problems here with the 200-day moving average. And then you do have support from the potential 50-day moving average here, so that could also help out as a support area, the 38. So what's going to happen here? I'm bearish on the short-term price movement of this company, so that's my thought on this. It's not a big fan of what Twitter's trading at now. I could see it going back up because it's been up, as high as $80 per share, not too far back. So I definitely think the company could still go up, but do I think it's worth what it's probably going to trade for if it does go back up? At this point, I don't. Not until I see some really big changes in Twitter that I think are going to actually produce what I would like to see, which is increasing in both active users and revenue per active user, which honestly are not doing so great compared to the other big social media companies like Facebook. So anyway, that's what I have for this video. Thanks so much for watching. If you like to hit that like button, subscribe to see future content like this, and watch another one of my videos on the end screen right now.